trying to buy out the business of the other, when you're buying out 50% of that business, that's a lot of cash flow to try and float for a company and a surviving owner to keep the wheels, not only keep the wheels of the business going without that other owner, but to cash flow that buyout. And so insurance is just absolutely critical. And you also run into a lot of old agreements out there. You know, if maybe they put it in place 10 years ago and haven't looked at it since. Well, they may have some stipulated buyout prices in there that are just extremely low, and so from that standpoint, haven't been updated. I've seen a lot of agreements where new owners have been added and some owners have been dropped off, but they haven't updated their buy-sell agreement. I mean, here they've added new owners, and these new owners aren't even have the same requirements on the as the previous owners on maybe transferring their shares or gifting them away. And so you really want to have some of those restrictions on not being able to transfer to others, to unqualified or contentious party or competitor. So you really want to make sure all parties are part of that agreement. So there's a lot of pitfalls out there from that perspective, and we're certainly here to help. Now, what are some of those questions that you can ask business owners to get them kind of interested in these services? One of them is just, do you have all the triggers in your buy-sell agreement? I mean, if you, first of all, do you even have a buy-sell agreement? And then do you have, does your buy-sell agreement talk about what happens how does an owner retire? What happens if somebody gets in a divorce? Do you have, is disability in your agreement? Is your valuation clear, specific? I mean, do they just have some formula out there? They had one that's where they had, the formula was a multiple of last year's earnings. And typically I like to see kind of if they're going to do a formula, kind of a weighted average or an average of a couple of years' results. But this one was just based off of the last year's results. It was a multiple of that. Well, of course, last year they had a negative earnings, and so really the buyout price was zero. And so if something would happen to one of the owners, their buyout price was zero. When really, if you looked at historically, the company was just kind of a one-down year. And so you'd hate to do the buyout where it's zero. And so certainly something that could be, from that perspective, maybe argued that it's really not a true fair market value, but that's what their agreement said. Other issues, I had a case where I had, they had 15 owners, business owners. And, we did a valuation for them, and I did this valuation, and it looked like, at a minimum, each owner was worth $200,000. Their interest each was $200,000. But the buy-sell agreement said that that they're going to, in case one of these triggering events occurred, the buyout price was $15,000. And I thought, wow, what am I missing? Maybe this is just a subsidiary, this buy-sell agreement. Or what's the big difference? So I inquired, and I found out, well, one of the 15 owners was an attorney, and the attorney is the one who drafted up the agreement. And the attorney, the thought was, this attorney thought, you know what, I'm going to buy everybody, I'm going to be the last one standing, I'm going to buy everybody out for $15,000. Well, the other owners kind of figured this out, and they bought him out for $15,000, and so he was kind of left hanging. And so that's why they wanted to review and to do the valuation, to kind of update their numbers, because they knew that $15,000 wasn't right. So just kind of, boy, reality is something else sometimes. Now, is there a mandatory buyout upon death or disability? The one thing you want to watch out for is these situations where, well, in case of death or disability, the company or the other owners just have the option to buy out our owner at death or disability, and certainly that protects the business, because it's going to protect the business. If they don't want the shares transferred to the spouse or children, they've got that option to buy out at death or disability. But what happens if you're that 15 or 20% shareholder of the company, and the company elects not to buy you out? Well, your family then could be receiving 15% of the company. Well, if you're just a minority owner of the company, those 80% owners, or the remaining majority owners, they could actually freeze you out of the profits by increasing the bonuses to themselves, so there's no profits for you at the end of the day, and your shares could be worthless. So you really want to have that mandatory buyout, because that's going to protect the surviving owners to make sure that there's a buyout of their interest, certainly if you're a minority owner of the business. So options to buy protect the company, but you really want to see the mandatory buyout to protect our business owner and their families. And then disability, is it defined and is it consistent from the standpoint, they may refer to disability, but is it the Social Security definition of disability, or is the waiting period, is that the same, the elimination periods? What's the buyout timing? sometimes you'll see, in the event of disability, in 30 days later, we're going to do a buyout. Well, what happens if the person recovers in 6 months and wants back into the business? So you may want to have some waiting periods in there. And is the true definition of disability, is it defined, and is it consistent with that disability buyout policy? And a lot of times we like to just point to that disability buyout policy so that that's certainly it's consistent from that perspective. So what we're kind of with this buy-sell portion, let us help. You don't have to be the experts in buy-sell agreements, but what we can do is, if you can, we're here to help you review these buy-sell agreements, point out what are some of the potential problems with these buy-sell agreements, and make sure that they are adequately funded. And this is a complimentary free service that we'll provide for your valued clients. And so from that perspective, just really excited to share with you this opportunity. So basically, we will provide our buy-sell review services. It's going to be two parts. One is we will do the review of the buy-sell agreement, go over a lot of these items that we just talked about, and we'll also do a free informal valuation of the business. And a lot of times, as I mentioned, we've done over 1,500 business valuations the last 3 years and about 350 buy-sell reviews. There's a lot of companies out there without buy-sell agreements who are just interested in the valuation services. And so we can certainly offer that to you as a complimentary service to your valued clients as well. But this is, we're not here to give the tax or legal advice, but it's a starting point for discussions with clients to get that process going, make sure that they do update the coverages correctly. And so with that, what is it that you're going to get? Once again, you're going to get that valuation. You're going to get a detailed review of their buy-sell agreement, discussing the major provisions and talking about what are some of the issues and concerns that are things that they may want to consider for their buy-sell agreement. And we're also going to look at the funding needs, both from the life and disability perspective. But once again, it's a starting point for them to work with their legal and tax advisors on these great services. And once again, it's a complimentary service to you, and it's just real exciting, and we're just seeing a tremendous amount of success with these services. And so with that, what is our valuation? So we do these informal valuations. We use 5 different methods, all industry standard. And what makes this service unique is that what we request is the last 3 years of financial statements of the company. So we're going to dig into these financials of the company and truly figure out what's the true cash flows to the business owners. You can't always just look at the bottom line, because a lot of companies, they're running other expenses through the business. It could be some of their healthcare costs, but it could be, a lot of times you'll see on the balance sheet they've got the company cars, a Lexus, or some of the fun ones I've seen is where they got the season tickets to the NFL games, or the one I had was a single owner business, and from the standpoint the board meeting was down in the Bahamas. So that is kind of all benefits that the company, being a business owner of the business, what are those benefits that owner's getting from the business? And so we'll look at those numbers, and then we'll calculate, we'll punch these into our into the results, come back with 5 true methods. But then what we do is we go out and benchmark our numbers with various websites to make sure that our numbers are consistent with not only the industry that the client's in, but your geographic location, so that we're not comparing chiropractic offices with from the Dakotas with New York City. So we're going to really compare with your geographic location to make sure that our numbers are consistent. And what we found, and the feedback we've received, is that we're right within 10%. I did a plumbing business, and the owner was like, boy, I just wish we would have talked to you 6 months earlier, because we spent $6,000 on a formal valuation, and they told me that our estimate, the principal's estimate, was 1.4 to 1.7 million, and the formal valuation the owner had done said was worth 1.6. So we were just right there, but he spent $6,000 getting a formal valuation when our informal one gave him that same number. And remember, this is an informal valuation, so it's not something that's going to hold up to the IRS, or if you're trying to fill out an estate return, it's not going to hold up from that perspective. If somebody's looking to truly sell their business or gift their business tomorrow, maybe a formal valuation makes sense. But there's a lot of business owners out there who really are not looking to sell tomorrow. But from a planning perspective, it's tough to say, am I on track for retirement or not? if I don't know what my business is worth? If my business is my retirement plan, if the proceeds I get from selling my business is what's going to contribute to my retirement, how do I know if I'm on track for retirement or not if I don't know the value of my business? And so it's a great starting point for those discussions, and especially after the last 3 years that what we've gone through here is that it's just a lot of business owners are uncertain. They've had some kind of ups and downs with the companies, and so at this point in time they just don't know, and so we're just seeing a huge interest in getting a feel for what the business is worth, and then it's going to open up all those different sales opportunities for you as well. Now, once again, this is just an informal service, so it's not something that, as I said, doesn't hold up to IRS. But what differs between ours and a formal valuation is a formal valuation is probably going to be well over 100 pages long, and they're going to go into details about the particular industry and the geographic location, and they're going to talk about all these different, a lot of details that are required for these formal valuations. But the bottom line is, you get to either the first page or the last page of that formal valuation, there's going to be a number, and that's what the business owner is interested in. And our report's about 10 pages long, but once again, it's going to give them a feel for what that business is worth. And once again, it's a great starting point to start those process. So they may find out that, what, I am very interested in selling my business, and now I'll go out and get that formal valuation, but they may not want to spend the money on a formal valuation now and get some of this initial planning done, look at some of their different options, and then go out and hire that formal valuation. But at least we can get this process started. And from our underwriting perspective, they generally honor these valuations that we put together. So if you go out and share this with your client, assuming nothing's really changed, we have all the facts with us. I mean, our underwriters are going to honor this, and you can use this for the basis of your buy-sell funding. So it's, from that standpoint, it's a great resource, and it's something complementary that you can use to approach business owners. I mean, this is something that you can take with you, and just as you're meeting with clients and say, we've got the opportunity to offer you a free valuation. It could be existing business clients who could be interested in this, or it could be approaching those new ones. So it's a pretty exciting service that you can offer. Now, one of the things with the valuations that, we're going to do a couple of different methods. One method is book value, and book value is basically if you took all your assets, sold all your assets, and paid off all your debts, basically the liquidation value is the book value. But really, when we do these valuations, we're looking at the company as a going concern. So from the standpoint of what are those earnings that's going to generate to these owners over time. And so we're going to look at the high value closer. What's that fair market value? And so what we kind of say is, the value, if you don't do any planning, if you don't put in a buy-sell, if you don't do some of these planning, your family's probably going to get book value, liquidation value for your business. However, what we want to do is we want to put plans in place to lock in that higher value and protect the value, that higher value of the business for you and your family. And so with that, the key is to make sure that we protect the business. So the book value is kind of the value without planning, but what we want to look at is those other methods, those other higher methods, and lock in those high values. Now, when we talk about these buy-sell review services for multiple owner businesses, but you may work with a business owner that it's only a single owner business, so they don't have any co-owners to do a business buy-sell with. And so for these owners, one of the things that you can do with these valuations is say, the book value, that's the value without planning, but we want to protect the high value for these single owner businesses. Now they don't have anybody to do a buy-sell with, so what we generally recommend is let's put some life insurance, let's put some disability insurance, personally owned, that in case something happens, that it's going to protect that difference between your book value and your high value, such that if you have to sell it at fire sale values, your family's still kept whole. And if you have that outside of the business, for example, with the life insurance, if you name the spouse as the beneficiary, if something happens to our owner, the spouse can either loan the money to the company,